Dividends Don't Lie, Finding Value in Blue-Chip Stocks by Geraldine Weiss is a seminal book in the field of finance and investment. It provides invaluable insights into identifying and capitalizing on value in blue-chip stocks. Let's explore the wisdom contained within its pages and discover how these 5 profound quotes can enhance our understanding of the world of economics and finance. 1. Invest in companies with a history of consistent and reliable dividend payments. Quote underscores the fundamental role dividends play in evaluating the financial health of a company. Dividends represent a portion of a company's profits distributed to its shareholders. By emphasizing the significance of seeking out companies with a track record of consistent and reliable dividend payments, Weiss highlights the potential benefits for investors. A company's ability to consistently pay dividends demonstrates its profitability and stability over time. It indicates that the company generates sufficient cash flow to not only cover its operational expenses but also share a portion of its earnings with shareholders. Such companies often have solid financial foundations and well-established business models that generate consistent profits. Investing in companies with a history of consistent and reliable dividend payments can offer several advantages. Firstly, dividends provide investors with a regular stream of income, making them particularly attractive for income-oriented investors seeking steady returns. Dividend payments can contribute to a portfolio's overall returns and potentially provide a stable income source, especially during periods of market volatility. Moreover, companies that prioritize dividend payments tend to be more disciplined in managing their finances and allocating capital. They typically adopt prudent financial practices, such as maintaining sufficient cash reserves and managing their debt levels responsibly. This financial discipline suggests that the company's management is committed to shareholder value and long-term stability. Additionally, investing in companies with a history of consistent dividends aligns with a long-term investment strategy. By focusing on companies that demonstrate a track record of reliable dividend payments, investors can prioritize stable, well-established businesses with the potential for sustainable growth. These companies often have a competitive advantage in their respective industries, allowing them to weather economic downturns and deliver consistent returns to shareholders. However, it's important to note that past dividend performance does not guarantee future results. Investors should conduct thorough research and analysis to assess the overall financial health and future prospects of a company before making investment decisions. Evaluating factors such as dividend payout ratios, cash flow generation, industry trends, and the company's competitive position can provide valuable insights into the sustainability of dividend payments. 2. Don't chase short-term gains, focus on long-term value. Quote highlights the significance of taking a strategic and patient approach to investing. In a world where markets can be driven by short-term fluctuations and trends, Weiss emphasizes the importance of looking beyond immediate gains and focusing on the long-term potential and value of investments. The quote underscores the idea that successful investing is not about chasing quick profits or trying to time the market but rather about identifying and investing in companies that possess long-term growth prospects and intrinsic value. By shifting the focus away from short-term market noise and speculation, investors can make more informed decisions based on thorough analysis and a deep understanding of a company's fundamentals. Investing with a long-term perspective allows investors to benefit from the power of compounding and the potential for sustained growth over time. Instead of being swayed by short-term market fluctuations or the allure of hot trends, investors who prioritize long-term value seek out companies with strong underlying fundamentals, such as robust business models, competitive advantages, and solid financial performance. By focusing on long-term value, investors can make investment decisions based on a company's ability to generate consistent and sustainable earnings and cash flow. This approach involves conducting thorough research and analysis to identify companies that have a durable competitive edge, stable management teams, and a clear growth strategy. Moreover, a long-term investment perspective enables investors to ride out short-term market volatility and economic cycles. It allows for a more patient and disciplined approach, recognizing that the true value of an investment may take time to be fully realized. By avoiding the temptation to chase short-term gains, investors can better position themselves for long-term success and potentially avoid costly mistakes driven by market speculation or emotional decision-making. Adopting a long-term investment strategy also aligns with the principles of value investing, where investors seek out companies that are undervalued relative to their intrinsic worth. By focusing on long-term value, investors can identify opportunities where the market may have overlooked a company's true potential, providing the possibility of capital appreciation over time. 3. Diversification is key to managing risk. Quote underscores the fundamental principle of spreading investment across a range of assets to minimize risk exposure. In the ever-changing and unpredictable world of finance, diversification acts as a protective strategy that can help investors navigate market volatility and uncertainty. The quote emphasizes that relying on a single investment or a concentrated portfolio exposes investors to significant risks. By diversifying their holdings, investors can distribute their investments across various asset classes, sectors, industries, and geographical regions. This approach aims to reduce the impact of adverse events that may affect any one particular investment or sector. Diversification helps mitigate risk by ensuring that the potential losses from underperforming investments are balanced out by the gains from other investments that may be performing well. The goal is to create a portfolio that is less susceptible to the volatility of individual stocks, sectors, or asset classes. When constructing a diversified portfolio, investors consider different types of investments, such as stocks, bonds, real estate, commodities, and alternative assets. Additionally, they allocate their investments across different sectors, such as technology, healthcare, finance, and consumer goods. This approach helps to protect against the specific risks associated with any single investment or sector. By diversifying their holdings, investors can reduce exposure to market fluctuations, economic downturns, regulatory changes, or company-specific risks. For example, if a particular sector experiences a downturn, the negative impact on the overall portfolio can be offset by the positive performance of other sectors that may be thriving during that period. Moreover, diversification also enables investors to take advantage of various investment opportunities. Different asset classes and sectors may perform differently under different market conditions. By diversifying, investors have the potential to capture returns from multiple sources and benefit from the growth potential of different sectors or asset classes over time. 4. Thoroughly research and analyze a company's financials before investing. Quote underscores the critical role of diligent investigation and analysis in the investment process. It highlights the significance of gaining a comprehensive understanding of a company's financial performance and position before committing capital. To make informed investment decisions, investors must delve into a company's financial statements and reports. This includes studying the income statement, which provides insights into the company's revenue, expenses, and profitability over a specific period. By examining the income statement, investors can assess the company's revenue growth, cost structure, and overall profitability trends. Additionally, investors should analyze the balance sheet, which offers a snapshot of the company's assets, liabilities, and shareholders' equity at a specific point in time. The balance sheet provides crucial information about the company's financial position, including its liquidity, solvency, and ability to meet its long-term obligations. By scrutinizing the balance sheet, investors can assess the company's financial stability, leverage, and overall capital structure. Furthermore, investors should review the cash flow statement, which tracks the inflows and outflows of cash within the company. The cash flow statement provides insights into the company's cash-generating activities, such as operating cash flows, investing activities, and financing activities. Analyzing the cash flow statement allows investors to evaluate the company's ability to generate cash, manage its cash resources, and fund its operations and growth initiatives. In addition to financial statements, investors should consider other essential financial indicators and metrics. These may include key ratios such as earnings per share, EPS, price to earnings, PE, ratio, return on equity, ROE, and debt-to-equity ratio. These metrics provide insights into the company's profitability, valuation, efficiency, and financial leverage. Thorough research and analysis go beyond examining financial statements. It involves studying the company's industry dynamics, competitive positioning, management team, business strategy, and future growth prospects. By gaining a holistic view of the company, investors can evaluate its competitive advantages, market opportunities, potential risks, and long-term sustainability. Investors should also stay informed about macroeconomic factors, market trends, and regulatory developments that may impact the company and its industry. By considering the broader economic and market context, investors can make more informed judgments about the company's future prospects and potential risks. The process of thoroughly researching and analyzing a company's financials requires patience, attention to detail, and a disciplined approach. It may involve studying annual reports, quarterly filings, conference calls, industry reports, and engaging with other reliable sources of information. By conducting comprehensive research and analysis, investors can make informed investment decisions based on objective insights and a deep understanding of the company's financial health, performance, and prospects. This diligent approach helps investors align their investments with their financial goals, risk tolerance, and time horizon. 5. Be patient and stay disciplined in your investment approach. Quote highlights the crucial qualities of patience and discipline that are essential for successful investing. In the fast-paced and ever-changing world of finance, it is easy to get caught up in short-term market movements, news headlines, and speculative trends. However, Weiss reminds investors to maintain a long-term perspective and adhere to a disciplined investment approach. Patience is a virtue that investors should cultivate. It involves having a long-term outlook and understanding that wealth accumulation through investments takes time. Markets can be volatile, and short-term fluctuations are inevitable. By being patient, investors can avoid knee-jerk reactions to market volatility and resist the temptation to make impulsive investment decisions based on short-term trends. Instead, they focus on the fundamental strengths of their investments and trust in their long-term growth potential. Staying disciplined is equally important in the investment process. It involves adhering to a well-defined investment strategy and avoiding emotional decision-making. Disciplined investors set clear investment goals, establish a diversified portfolio, and follow a consistent approach based on their risk tolerance and investment timeframe. They understand that consistent adherence to their strategy, even during challenging market conditions, can lead to more favorable outcomes over the long run. Discipline also extends to risk management. Investors who stay disciplined have predefined risk management strategies in place. They set appropriate stop-loss levels, regularly review their portfolio's performance, and rebalance their holdings when necessary. By maintaining discipline, investors can mitigate the impact of potential losses and make rational decisions based on their predetermined risk tolerance. Furthermore, discipline in investment decision-making helps investors avoid succumbing to market noise and herd mentality. It enables them to conduct thorough research, analyze investment opportunities objectively, and make independent judgments based on their own analysis and convictions. By staying disciplined, investors can resist the urge to follow the crowd and make investment choices that align with their long-term goals and objectives. Dividends don't lie. Finding value in blue-chip stocks offers timeless wisdom that can guide investors in their pursuit of financial success. Geraldine Weiss's quotes serve as powerful reminders of the importance of dividend payments, long-term value, diversification, thorough research, and patience in the world of economics and finance. Like, subscribe and join us in future episodes of Financial Success Blueprint as we explore more influential voices that have shaped the field of finance.